going to tell you what's at stake for the country. I'm going to talk a little bit about where I see Washington going. Next week's a huge week. I'm going down there. There's a lot of activity going on in Washington. And I think a lot of what we've been hoping for years is about ready to break open. And I couldn't be more excited. That said, it doesn't mean that we're going to see everything overnight. But because usually if we get more legislation passed, as you can see, the Jobs Act was passed on April 5th of 2012. I was at the White House, one of the greatest treats of my life. Only half of the job-creating elements of the Jobs Act have been implemented today, yet it seems to be having some of its intended effect. So see if we can. So we're going to talk about raising capital, supporting stocks, and driving growth, the distribution aftermarket support, the role of Issuworks, and then venture exchanges. Venture exchanges is a new concept, and it encapsulates, we think, will encapsulate Reg A+. Talk about that in a second, but this is going to be a big, hot topic. It's just something that we wrote about back in 2011. We called it small cap exchanges, and now all of a sudden it's starting to get life. So people refer to me as the father of the Jobs Act. The reason is for these published studies that are out there. You can find them up on our website. We have a section called Better Markets. I left NASDAQ as vice chairman, and it was really during what I affectionately call the bubble rubble, and we were delisting stocks like mad after the dot-com bubble. And I put it together that the cause was really we'd changed market structure, and a lot of people didn't understand that. And so I sort of then in 2007 started to say, okay, like in network, I'm mad as hell, stuck my head out the window and said, I'm not going to take it anymore. So we started to try and get other people to see what we saw. And it was, for us, it was obvious, but it really has been a non-obvious problem for most people. And so we had to create a tipping point from an information standpoint to get other, if you will, evangelists of the fact that we have to change market structure. It's been a long process. So why are IPOs in the ICU? Market structure is causing the IPO crisis and more. These were two papers, actually a wake-up call for America, that were cited by Congressman Dara Albright, who was the head of the House Oversight Committee, in a letter that he sent to Mary Shapiro, who was then the chair of the SEC. And that set a lot of, created all of a sudden surge of momentum. He asked the question, look, these guys have documented the decline in the IPO market, what's going on? And then all of us, then it started to go global. I got asked by the OECD to write a paper, and we wrote one called Making Stock Markets Work to Support Economic Growth. And so now I think on April 10th, I'm going to be in Istanbul potentially to go. They're socializing it with the G20 now. And the basic idea is that, that we've really stunted entrepreneurship, not just, and the numbers of IPOs, not just in the United States, but globally. Because as we pursue, we'll get into this, the electronic market structures. So, some of the indicia, the Federation of European Securities Exchanges had me keynote their IPO summit back in July. The European Commission there actually was citing our work by name. This is, this is where you go from being the resident loon to all of a sudden the conventional wisdom in the short space of 3 years. It's kind of gratifying on some level. OECD G20. So next week in Washington is going to be a big week, okay? The sun and the moon and the stars are aligning. I'm going to be speaking to people at the Division of Trading and Markets about this concept called venture exchanges, addressing the SEC Advisory Committee on Small and Emerging Companies. That'll be on the 4th. I'm meeting with 2 of the key congressional aides for 2 of the congressmen, 1 Democrat and 1 Republican, that have been very active in wanting to pass legislation. They're on the right committee. They're both on the House Financial Services Committee, and specifically the subcommittee on capital markets. So the way that Washington works is you have to be on the right committee to have standing really to introduce legislation. And we've been really good at kind of changing the way you talk about these subjects to make it work for Republicans and make it work for Democrats. And I'm not shy about things. I mean, I think that on the Republican side, they want more access to capital and they want less regulation. On the Democratic side, they need jobs. And when I went into the Black Caucus, and I went in with two African-American women, one was Kim Wales, who's known to crowdfunding circles, and Lisa Newport, who was the co-author of our OECD work. And I said to members of the Black Caucus, you're putting black people out of work, and this stock market structure that African Americans are deriving no benefit whatsoever, because the average African American, at least at the last time in the Pew Institute studies was 2009, they had at the time like $5,900 in net worth per African American. They're not day trading stocks. Now it's up to maybe 11,000 as of 2013. So when you sort of sit there and you think, what are you doing to your constituency on some level? They're not actually in the market deriving benefit, but they sure as hell need jobs. And when we look at poor youth in this country that are undereducated, we need full employment to get them back up, back into the workforce to learn something, because otherwise you sit there, you get stale, or you get into trouble, incarceration rates go up, nothing good happens, okay? So we've been through this really underemployed market, and I think everybody is intuitively really suspect about the employment numbers. We all feel that the level of unemployment is actually higher than has been stated by the official statistics, partly because so many people have just given up working. So I have come to the conclusion that the market structure that we created in this country was not intentionally, was well-intentioned, but it is an amoral market structure because it really did a lot to hurt people that could afford to be hurt the least, okay? So expect the Senate to hold hearings on venture exchanges. I heard that through the grapevine in the next 2 or 3 weeks. So I've been in touch with some people in the Senate. So here is the op-ed that we published in 2011 in the Wall Street Journal. And you will hear this phrase repeated now by Chair White. She's the SEC chairwoman. Lots of people in Washington that we kind of have, we talked about our large cap, high frequency trading oriented markets as being one size fits all markets. And that trading has become a disaster for all but our nation's largest companies, and our rush to cut trading spreads and commissions has made large caps even more active, but we've abandoned the entrepreneur in the process. These are the people who take on the most business risk and job creation in this country. With such inhospitable stock markets, mergers and acquisitions have become virtually their only outlet to realize value for their hard work. And as we've so often seen during this tough economy, M&A generates job cuts, not new jobs. That's why young, dynamic companies need renewed capital market support so that they can grow independently without being forced to sell. And then what we said was what's needed now is a new parallel market for public companies under $2 billion in trading value. Trading rules in this new market would allow for higher commissions, really trading spreads. We thought that was a little too obtuse for the market, but both, and which would provide adequate incentives for small investment firms to get back into the business of underwriting and supporting small cap companies. And I said that the SEC could use its authority under securities laws to exempt this market from rules standing in the way, or Congress can step in. And I think we're starting to see that both will happen. But think about it, 2011. I mean, and now we're hearing people use this terminology, venture exchanges. It's taken a while. So the program, I'm going to talk about why this is a massive problem, why everyone should care, the causes, the solutions from Issuworks' perspective, and then what we're seeing in Washington in a little bit more detail. So here's an IPO chart, goes back to 1991. These are some of the things that were in our work. It's updated. The yellow line is the Dow Jones or the S&P 500 stock price. And what you see is the dark blue tranche in each of these bars, 1991 to 2014, is small IPOs. And you can see that we did a lot of small IPOs once upon a time. That's sub $50 million IPOs, and then poof, starting in 1997, 98, they started to come down abruptly, and then by 2000, 2001 was the end of the dot-com bubble. 2000 it ended actually in the middle of the year. It just kind of crashed, and it's never recovered. And the interesting thing is that if you look in this period before 1995, that's really the pre-dot-com bubble period. You see the stock market's up, not up that much yet we're doing an average of 500 IPOs a year. Well, we've averaged only 150 total IPOs a year since then, and because our economy is larger, okay, we should be doing 900. So that delta between the 150 we're doing and the 900, 10 million jobs to the US economy. So here, this is the investment banking system back in 1994. And those that are in blue are still around, and those that are in red are gone. Now, a lot of them have been consolidated out, but the fact remains that we don't have the capacity to do the banking that we once did because a lot of the smaller firms in the ecosystem have been driven out of business. Now, just so you know what these are all firms that did at least one lead-managed IPO. So there's a lot more firms that are registered with FINRA, but they're not active in the investment banking business. They're not big enough scale. So the firms that were doing book-run IPOs, there's a small minority of them left. And actually, if you look at the crowd doing small IPOs today, it's maybe 30 firms. Okay? That's the collapse of the ecosystem. So by the numbers, the US fell from number 1 to number 12 in small IPOs on an absolute basis. If you do it on a GDP-weighted basis, we tested for the OECD 26 countries, the largest 26. We're now on a GDP-weighted basis, 24th out of 26 in small IPOs. Anyone want to venture who we're ahead of? They weren't in the top 26. Mexico and Brazil. And might as well be. So we fell from number 1 to number 2 in large IPOs. So this is, again, one size fits all. The market's optimized to trade large cap stocks. So that's why that hasn't fallen as much, but it's starting to. And if you saw Robert Lighton's, who's the economist, published a big article in Foreign Affairs recently. He defines a startup as a company that's less than 1 year of age. And he's going back 30, 40 years looking at what percentage of companies were startups in the US economy. And back in the 80s, it was 14%. And today, it's down to 8%. US fell from 9,000 to 5,000 listed companies. That's NASDAQ, New York Stock Exchange, Amex. We were the first to discover that. I'm not sitting there, to me, I mean, come on, guys. This has been going on for a long time. Why does it take us to go do the research to shine a light on something that they probably should have known? And by the way, what was difficult about it was the stock exchanges were obfuscating the data by reporting all of their exchange-traded funds, all their non-operating company listings, closed-end funds. So it looked like things were actually doing better, a lot better than this. But when you just looked at the sample set of real companies that employed people, wow, Armageddon. And then US IPOs fell from 500 a year, as I mentioned, to 150. So why should everyone care? Jobs, poverty, retirement, you need growth, innovation, okay? I have zero confidence in man's ability to restrain himself, herself. Global warming, okay? But I do have confidence in getting more money into the hands of scientists and engineers to innovate and find solutions to these problems. So the cure for cancer is not going to happen spontaneously. It's going to happen from lots of money being poured into lots of things, and a lot of that money will be lost. And where I come from, because there's like Professor Jay Ritter from the University of Florida talks about IPO failure rates being extremely high. And I'm like, so, okay, that's a good thing. That's a good thing, right? Look at the risk-taking culture that once upon a time we had back in the days of transistor vacuum tubes before semiconductors. We put a man on the moon. Okay, think about that. We got into covered wagons. We went across the country. We didn't have hospitals to go, and we didn't have cell phones. And now we're worried about people losing a little bit of money on the investment front, I think it's kind of ludicrous. And what happens is this cure is much worse than the disease. renewable energy, internet security, national security. You need a strong economy to pay for that military. You need a strong economy to innovate, to create solutions to defend the nation over that internet architecture. We're being assaulted every single day by the Chinese and the Russians over the internet. And we're, I'm sure, playing tit for tat. But the fact of the matter is that our security as a nation depends on us keeping a lead. And that's going to come from entrepreneurs. So the causes, very, very quickly, the big one, this is a slide that was actually popularized in the House Subcommittee on Capital Markets, where they put it up on a, and this is an updated version. I just wanted to show you what's happened since the Jobs Act. So the dark blue tranche is sub $50 million IPOs. The yellow is how big would an IPO be, and how many IPOs would there be if it was inflation adjusted. So today, an inflation adjusted $50 million IPO from 1991 is about an $84 million IPO in 2014. And you can see that the small IPO fell off a cliff in 1998. What happened in 1998? Regulation ATS. Why wasn't it seen? Because it was in the middle of the dot-com bubble, lots of deals going out. Nobody thought ever to look there. They looked at decimalization in 2001. When we went to pennies, everybody thought that was the problem. Well, guess what? We gutted most of the economic incentive before we went to a penny. We went from a quarter point with Reg ATS down to 3.125 cents or a 32nd. That was the conversion to electronic stock markets. We used to have a quoted spread where a trader could hedge their risk. The other thing that happened around this same time is we had a massive increase in the number of self-directed accounts at the E-Trades, so the retail broker was beginning to be disintermediated. It was the economics that fell apart to support small cap companies that caused people to flee the market and not be willing to take on small IPOs any longer. And it never recovered. Now, if you look at the Jobs Act, right, where it's starting to come in, we've done 40% companies on an inflation-adjusted basis. So it's up. We're halfway to where we need to be. We need to be, for a healthy market, we need to be at the 80% mark. And that's when we'll drive to 900 IPOs in an average year. By the way, the cycle numbers are pretty huge. And we should be doing in a down cycle 500, which is, given the size of the economy. In an up cycle, we should be doing 1,200 IPOs, which to some people are staggering numbers. But those are the GDP-weighted numbers if we hadn't done anything to market structure and we were looking at the same kind of markets that we had in the early 1990s. Okay, so it's not crazy. No money for sales, distribution, market making, and small cap stocks. And so now this is the crowd that you see that are the 2014 book runners, what some academics now attribute to Weild and Kim. Ed Kim is my co-author. He's the one with the brains, 800 math SAT guy out of MIT, and traded equities at Lehman, wrote research at Robbie Stevens, and they call it the ecosystem theory of small IPO decline, which is that when you starve the system of adequate economics, you start to drain capacity. You lose brokers, that are actually marketing stocks, you lose research, you lose capital commitment, and the firms starve, and so as a consequence, you see a much smaller ecosystem. This is your ecosystem. So I wanted to talk a little bit about what we're doing at Issuworks, and we said, look, we've decimated all the distribution in the country. We had 100,000 retail brokers that were marketing stocks. They're now asset gatherers. We had middle market institutional sales desks. And so even though we may have concentrated allocations of new issues to the same, or many large institutional investors, we had this remarketing engine that went on in the aftermarket. What happens is now stocks are getting placed with the wrong accounts. They can't really own them because they're liquidity constrained. It gets flipped, the real marketing job out to there's 3,000 institutions in the United States. There's about 60 institutional investors that generate 90% of the commissions to Wall Street today. And so the others are not really being prioritized, and it becomes kind of a random walk event. So what we're doing is we're using data to understand who the right matches are. And then we're developing marketing systems and putting technology in place so that we can go now into accounts and say, you own these 5 stocks, this one's relevant, here's another one. If you like this one, you'll like that one. Allow them to see the roadshow online and then follow it up with a phone call. Guess what? We're doubling demand on offerings, okay? But more importantly, we're saturation marketing with the right people. We're getting them up the curve about the company in the course of the offering when more institutions are now educated about the company. So as a consequence, we believe that the aftermarket will be better because you've used that event when somebody has to make a decision to actually get them educated. We're also doing this in the aftermarket now around major conferences. So for instance, Lionsgate Entertainment is on the high end is a client of ours. What we found was $4 or $5 billion market value companies are saying Wall Street's taking me around to see the same 20 institutional investors. And so what we're doing is we're doing our analysis, and then we're trying to make sure that when they go to the Deutsche Bank or the UBS conference or the Piper Jaffray conference, that we aggressively market to more best fit institutions to make sure that their one-on-one schedules are with people that can actually own the stock. And that seems to be something that resonates with already public companies. What we did was we raised an A round. It was oversubscribed. We got our early proof points. We're looking towards becoming self-sufficient. We're starting to see quite a bit of already public company business come into us. I think interestingly, we're actually starting to see investment banks want to partner with us. So we're going to be white labeled into some deals with some well-known middle market investment banks. We're actually co-pitching with some investment banks because what we do is totally complementary. We get to the long tail of the distribution curve, that other 3,000 institutional investors. And our objective, this is sort of the first phase of trying to create a utility, a platform that could ultimately be the most powerful equity distribution and redistribution platform in the world for public company stocks or people that are tracking to go public. We may bring it down to the private market at some point, but we think that there's plenty to do in the meantime. So these are what investment banks are of interest. These are all the use cases, small IPOs. We're going to do a $20 million IPO that we're just getting engaged to do, uplistings from the over-the-counter market to NASDAQ, piped offerings, registered directs, confidentially marketed public offerings. Why? Because Wall Street's capacity constrained. And when you do a wall crossing transaction, they go to hedge funds and they go to the guys that already own the stock. There's no attempt to broaden it, and they can't use the institutional sales force because of information leakage, okay? Because they'll put pressure on the stock. So what we're doing is we're actually giving them double, triple the amount of firepower on a deal to broaden the demand, condition the market so that the aftermarket trades better. Accelerated book build offerings when you have to compress the time to get something done. Overnight offerings. Shareholder-based transitions. Think about SPACs. A special purpose acquisition company acquires a new co. It's in a brand new industry. You have to transition the entire shareholder base. How do you do that? We do that by making sure that we rifle shot into all of the important companies. Now, if I fast forward, and I told you we're actively working with investment banks, corporations. We actually have venture capitalists that have pulled us in to try and look at getting smaller IPOs done right now. It's kind of interesting. Everybody's really interested in can you make that $20, $30 million IPO work? And we're doing it through data acquisition, data science, CRM engines, direct marketing engines, computer telephony, and then ultimately feedback, and we're providing, as I mentioned, support to Wall Street and support to companies. So, as I said, we can double demand on most offerings now, where we're going, and I think this is really more important about the vision is we're automating sales and marketing is what we're doing. And we're bringing down that cost because we think that we can get Congress to increase the incentives, but I think that everybody needs to do things better, faster, cheaper. So the vision is ultimately algorithmic placement, it's IPO in a box, crashing the cost of getting management teams ready to go public, and we think that there's a whole suite of potentially viral applications. So when we get into the second and third phase, the dream is ultimately to get everybody to kind of perfect the tools and the approaches in-house, and then to distill it down into technology once we've got all the use cases down, and then to be able to put it out in platforms so that we can sort of spread the love, so to speak, and to be able to systematically do a better job of getting capital into microcap stocks. If you do that, then you raise valuations, you raise throughput, and it becomes not so crazy any longer to take smaller companies public. So we'll get help from the SEC and from Congress, hopefully with changes in the regulations, but at the same time, we think they won't give us enough, and that there will be a real need to be able to systematically market securities much more effectively than they've been done to date. So I want to just quickly get into what's going on in Washington in a big way. This is going to be, I think, the most important year since the Jobs Act was signed into law in 2012. And I actually think that in terms of impact on markets, that this one could blow away 2012. If you look at what happened in Congress, the Senate was a bottleneck, okay? And it was because Harry Reid, who was majority leader when the Democrats were in power, wasn't letting a lot of legislation get to the floor of the Senate. And it's not that these ideas were particularly controversial, they were really bipartisan. You just couldn't get the Senate to put up an analogous piece of a companion bill, a comparable piece of legislation, and so things just never went anywhere. People don't know it, but the reason why the Jobs Act got passed into law had nothing to do with the Senate. The Senate had no bill of its own. They took the House bill, and we've gotten into the White House, and there's a fellow named that some people in this room know, Doug Rand, who was a senior policy advisor to the White House, and the president in his job speech in 2011 said that one of the things that he was interested in was stripping away the red tape from doing IPOs. We got into the White House. That was pay dirt, 2011. And so the president, and I heard this from guys I went out to have beers with from the House of Representatives after the signing of the Jobs Act, told me that the president put 2 lobbyists on the Senate Democrats telling them that the president wanted the bill. So the Jobs Act got done because the president wanted it to, but it was mostly, almost in its entirety, legislation that was authored by House Republicans originally. A little bit of the back room, the backstory. So we expect now, because the Senate is controlled by the Republicans, we expect that the Republicans would like to get some legislation through. So the House has been working. There's been a lot of legislation there. We think some of this stuff is now going to get brought over to the Senate. The tick size pilot, as you know, the SEC has been, plan has been pretty much hijacked, but it's still a net positive. There was who knows what a tick size is here? I want to see some hands. I got a few guys, because you want to know, 2 years ago, I love that, because 2 years ago, nobody would have known what a tick size was. Tick size is the smallest increment that you can quote a stock in. And in the United States, it's a penny, okay? And what we argued was it should be nickels, dimes, even 20 cents. And we've written a lot. There's another paper called The Trouble with Small Tick Sizes. And we just said you can't trade micro-cap, nano-cap stocks with penny tick sizes, because what happens is electronically people collapse the spreads. Nobody can make any money, so all the capital comes out of the stocks. You need to get market makers in there. You need a more orderly market. And also it becomes, if at a penny, if you can collapse it down to a penny, it's very easy for somebody to short for nothing at stake and disrupt these stocks. You can push them down. But if you put it up to a nickel or a dime, it's going to cost them a nickel or a dime. And they've really got to move the stock, so people are going to think twice about messing around with a lot of these micro-cap names. So at any rate, there's been, it passed the House 412-4, but there was no bill in the Senate. So we think that some of this stuff will change. But what's really interesting now is this growing interest in venture exchanges. And Mary Jo White's picked up this language. Commissioner Gallagher has been really, really good. Read his speech up on the website at the SEC. He talks about scale disclosure. He talks about, even creating, a series of venture exchanges where there's competition to come up with a better market, obviously exempting you from some of the problematic rules that have caused trouble. He kind of totally gets it. And I'm very impressed with Gallagher and his knowledge. So scale disclosure, new stock exchange model. I mean, think about it. This will be a stock exchange model that is optimized for the needs of small cap companies. That's where it's going, whether it's private or public. That's the discussion now in Washington. And then, so you finally look at Reg A Plus, and it may just get wrapped into venture exchanges. It may be the disclosure that we use for venture exchanges, who knows? I mean, what I'm going to push for, just so you know, is I think that it's not understood that they probably need to get the caps on how big the companies are in venture exchanges much larger, because even though you might say that a $2 billion or a $1 billion market value company could trade in the regular stock market, the problem is that what you're doing is you're siphoning away a lot of economics to that ecosystem. And if you have bigger cap companies that can be in a venture exchange, it's going to feed more research, more sales, more trading. It's subsidizing. And anybody that grew up in the stock exchange business, going back 20 years ago, will tell you that the only reason why the New York Stock Exchange specialist system worked was because the specialists were allocated big stocks. They extracted excess profits from the trading, because you can't, Intel, Enron, you'd have to commit $500 million, Exxon rather, you'd have to commit $500 million in capital to move one of those stocks 1% in price. No specialist had the capital to so-called make markets in large cap stocks, which are innately liquid. Academics call these symmetrical order book stocks, okay? But what happened was, in order to have the right to earn excess profits, the specialist had to subsidize liquidity in microcap names. They were held to certain trading standards, and so we were taking economics from large cap stocks as a public policy matter. It was a sound public policy, and we were subsidizing liquidity in microcaps because it was in the public interest. One size fits all. Stock markets obliterates that. It shouldn't be a surprise that we collapse small cap markets. We took away the needed economics from these stocks, and we put them on the same footing as hyper-efficient penny tick size, Intel's, Microsoft's, ExxonMobil's, and we reaped what we sowed. So, and by the way, I mean, as Sam was mentioning about Reg A Plus rulemaking and/or legislation, what's really going on behind the scenes, I mean, I hear this as a rumor, so I can't verify it, is that NASA's been threatening to sue the SEC because the SEC wants to preempt state regulation. And what I will very unabashedly say is that small cap companies need an extra layer of regulation, like they need a hole in the head. And I think that NASA should stick its red, white, and blue epaulets on when it approaches this, and stand down and let and whether Congress ultimately has to preempt state regulation or the SEC does it, that is the right decision for the American people. We need less cost. More importantly, we need even less unpredictability, because what happens is, and I think was it on your Reg A offering, you said you filed in 10 states and you only passed in 8. Was that what I heard? And that's very typical, and that uncertainty in the old days, back when NASDAQ stock market, everything had to be blue sky. NASDAQ didn't enjoy an exchange listing exemption. What happened is we had a lot of infrastructure at the wirehouses, and we could move stocks around from state to state. So if you failed in California, you could move that stock very quickly and ticket it if you had excess demand in New York. But that infrastructure doesn't exist any longer. And so what it does is it creates a logistical problem, a logistical nightmare, and a set of uncertainties and a layer of costs, which is just, totally wrong-headed. I mean, we should be doing less costs for small companies, not more costs. Crazy. So our vision, this is what we think we can help drive between public policy and between where we're going with Issuworks. And this is what motivates us. We think we can get the U.S. ultimately long-term back to #1 in small IPOs. That's the goal. We're the world's biggest economy. We should be #1. And so I've said to people in Congress, and I'll say this at the SEC, we need to manage by objective. We need to keep pushing, because the real health indicia will be the number of small IPOs that we're able to do. The U.S. fell from number 1 to number 2 in large IPOs. Again, this is because we've gotten too efficient, and the ecosystem is even starting to drain at higher levels. We're starting to show some problems there, and the U.S. needs to go back to number 1. We need to go back to 14% startups in this country. Now, why are the two related? Because if I can take down the barrier, the hurdle to take companies public, and we can take 900 companies public, that means more private investors will receive exits, which will free up more capital to reinvest in private companies and startups. And this creates a virtuous circle. This is what we call the equity supply chain. And we have an amazing hole in the equity supply chain in the United States right now. And so, if you think guys that took startup risk and had a big killing, more likely than not, they're going to go and look at other startup kinds of situations. The U.S. needs to go from 5,000 to 13,000 listed companies. Why? 13,000 sounds like a lot. Well, we went from 9,000 to 5,000, but if we had not changed market structure and we grew at GDP growth rates in line with the growth that was seen in Europe and Asia, we would be at 13,000 listed companies today. So we need to get back at it. And then finally, as I mentioned, we need to go from 150 IPOs a year to an average of 900. So our vision is that we want to become the world's most important securities distribution and marketing platform in the world. We want to be a utility. We want to support other investment banks. We want to work with everybody. We don't want to replicate the infrastructure that's out there. There's a lot of institutional relationship sales. It's there, it works. There's a lot of big brands people want to work with Morgan Stanley, Goldman Sachs, smaller brands, Piper, Cowen and Company. We have no interest at all in disintermediating them. We want to make them ultimately more successful at what they do. We think that if we do that, we think we can get and ultimately be designed into every transaction, because on the margin, we think we will be able to improve every transaction. And that's our vision. But are there any questions? Steve?
How did you raise that A-round capital?
Well, it was, as much as you don't know everything, right? And I figured, I know more about this subject, I think, sometimes than anybody in the world. And I really do. I mean, I spent my life researching it. I've grown up. I've done jobs in equity capital markets, investment banking, stock exchanges, interface with the regulators. Very few people have done those things. So I can knit it all together. Should be obvious to venture capitalists. Totally non-obvious. They don't get it. And, but what I found was just classic affinity marketing. Everybody that's invested in us has taken small companies public in the past. They've had problems. Larry Cohen, that was his experience. Mark Cuban, that was his experience. I'm talking about investors. I mean, we went out and spoke. We got some great guys. Kevin Kimberlin, first money into Next Level Communications, Myriad Genetics, Sienna Networks. And then everybody else that's invested is guys that were former equity research analysts, institutional equity sales traders, institutional salespeople, because they understand the business. They know what we're doing. And when we say that distribution's collapsed, they've lived it. That when we say that securities are under-marketed, they lived it, because they're in these businesses still, trying to make a living. And so we have great conversations with guys that are running deals on desks, because everything that we say, they understand it. They understand that their salesmen are not getting the long tail. They understand that they can't afford to. They understand a lot of times that they're getting lied to. Even when they assign them the call, the guy's saying, yeah, I made the call, they're not interested. And so rather than naming and shaming Wall Street, we understand the reality of the economic model, and we know that they've evolved to this point where the accounts are all larger cap and higher turnover. And so we say there's value in their relationships. Let's honor them. There's value in their brands. There's value in their equity research coverage to issuers. So we want issuers to have their cake and eat it too. But what we want to do is we want to lift out, business process outsourcing is really what it is. They want the calls made. Okay, they really do when they understand what we're doing. They're just control freaks, so we give them a way that they can control it, they can direct us. We work as partners, and so they feel very comfortable with what we're doing. But there's such an opportunity, particularly for small cap stocks, that I like to say that in my sleep I can double demand on any offering. Not on General Motors and Facebook, because because the lion's share of that stock does end up with Fidelity and T. Rowe and all those accounts. But for the 90% of issuers that are smaller, we can help. We have a problem when we get to a certain really small size. It's very, very difficult because the information breaks down when you're getting down to sub $50 million market value companies. Ultimately, though, we want to create our own information sets, and we want to take it all the way down the size curve. So we've taken on like a $20 million IPO because we want to push it right now as far as we can go. We want to learn something from that. Questions? Okay. Look, it's your country, okay? Talk to your congressman. Keep pushing. And to tell you, this is a team effort. It didn't happen because little Davy Weild said it. Didn't happen because a lot of other guys started to pay attention and started to get down there and started making noise. Yeah?
This may be a little off topic. What is your opinion on today's FCC decision on net neutrality? I see there's been mixed reviews on both sides of the partisan aisle.
Yeah. I mean, I think it's a bit of a red herring on some level. I mean, I think it's good because I think that what would have happened is that the big telcos would have extracted more fees from people and our service would have declined. I mean, they're getting paid a lot of money. Look at your mobile. You're connected to the internet. What are you paying for this? I mean, I've got my wife and 2 kids and myself on it, and I'm paying $250, $300, $3,600 a year. And then I've got cable at home. So I think we're spending actually a lot of money on internet. You pay for your connections in the office. And so, I think that if you look at the big, the Netflix of the world, they've got server farms, they've got multiple points of presence, they're paying for it in infrastructure to be able to get there quickly. I think it was, I frankly think it was, I think it was big companies behaving badly is my own view, and I think that the FCC made the right decision. Yeah.
How are venture exchanges going to solve liquidity? Is it larger ticket sizes, needs more research, needs more trading?
Yeah, well, we're writing a paper right now on it. It's how you define it. It's this kind of one-size-fits-all market, but very clear that they have to have a different economic model at a minimum, both in private and public. You could call it a public venture exchange. You could have a private venture exchange. So we're asking the questions: what needs to happen to make these markets work? And I think you're going to need, clearly. In the U.S., in the public markets, you have something called Reg NMS, National Market System. Everybody competes for their orders, and it kills economic incentives. And I hate to say it, but you're going to need some form of regulated pricing by the exchanges. And it may be that the competition comes in terms of multiple venture exchanges having closed systems and being able to determine how to charge people. But if in a marketplace you compete only on price, then you can't also compete, particularly in small cap companies, on the provision of value. If you want the market, the ecosystem, to compete on value, which is research, sales, and capital commitment, liquidity provision, then you need to have fixed pricing of some sort, a minimum amount of pricing. And I think that's going to be a core part of these markets. That was what the whole discussion about tick sizes was, raising tick sizes. Okay. I'm sorry to keep you from booze. I will be around, and this is, the next 3 years I think are going to be unbelievable for capital markets. Unbelievable. It's the most optimistic I've been in literally since the dot-com bubble burst, since the dot-com period. People are getting it. They're getting it en masse. When I go and testify at the House Subcommittee on Capital Markets, and Gwen Moore, who is an African-American woman from Milwaukee, puts her fingers up in the air and says, "I'm really interested in this tick size idea," we're getting through, okay? I wanted to go up and kiss her. Okay. Thank you.
All right, thank you, everyone. And now let's hit the bar.